When you hear the phrase prime real estate, the image that usually comes to mind is a glass skyscraper in a financial district or a downtown penthouse. But the most strategically contested physical assets in the global economy right now look like this: the massive, flat, gray distribution center. To secure this territory, the American logistics giant Prologis just launched a £12.6 billion all-share bid to acquire its UK-based rival, SEGRO. SEGRO's board rejected the offer immediately. They described the multi-billion-pound proposal as opportunistic and the price as insufficient. This raises a question. Why are two multinational corporations fighting a cross-border financial battle over flat warehouses in the suburbs? To understand why an offer of almost £13 billion is considered a lowball bid, we have to look past traditional metrics of commercial property value. Look inside one of these hubs. The e-commerce boom requires high-volume, hyper-organized packing floors to process millions of packages every single day. Then there is nearshoring. Companies are moving supply chains out of distant manufacturing hubs, placing them directly adjacent to the populations buying their products. Simultaneously, expanding data center industries require massive amounts of secure, structurally sound floor space to house endless racks of hardware. Real estate investors have a specific term for these buildings now: mission-critical infrastructure. Logistics properties transitioned into permanent utility networks, decoupling from the cyclical patterns typical of local housing. Whoever owns the physical concrete where goods and data stop before reaching your door controls the primary gateways of modern trade. Building new industrial estates from scratch is becoming increasingly difficult. Urban land in high-value corridors is too heavily regulated and expensive to acquire piecemeal. Because organic development is bottlenecked, corporate landlords are shifting their strategy to acquire existing competitors to gain scale quickly. Merging Prologis and SEGRO creates a continuous global supply chain platform. Notice the valuation disconnect. Public REIT stock prices sit much lower than private market asset values. Prologis exploited this gap. SEGRO rejected, citing their true net asset value and future pipeline. The daily ticker of a public stock can often hide the private market value of raw concrete, steel, and a strategic location. This corporate battle is part of a broader movement of global capital seeking defensive income. A multi-billion-pound offer, even a rejected one, establishes a new benchmark for how logistics real estate is valued worldwide. That benchmark forces investors to hunt for higher yields, rotating capital toward emerging markets to find targets before they are acquired. South Africa is a prime example of this trend, where logistics infrastructure is becoming one of the most actively repriced segments in institutional portfolios. Regional assets tied directly to international shipping, such as port-linked logistics hubs, are seeing renewed interest. These independent ports are being integrated directly into massive global distribution networks. Whether Prologis ultimately acquires SEGRO or not, the bid establishes a valuation standard that will influence property pricing for years. In the world of institutional capitalism, the humble, gray highway warehouse has replaced the skyscraper as the ultimate prize.